The scenario begins with a shocking announcement. The U.S. government declares a massive reduction in federal employment, terminating 40% of its workforce across agencies, departments, and state-level federal operations. The news spreads like wildfire through media outlets, financial markets, and the corridors of power. Citizens, corporations, and investors scramble to understand the full consequences, realizing immediately that the U.S. federal workforce underpins nearly every aspect of national operations, from defense, healthcare, and social services, to regulatory oversight, transportation, and economic policy implementation. The initial impact is felt within government operations. Agencies experience operational paralysis as critical personnel vanish overnight. Departments responsible for tax collection, public safety, transportation regulation, social security, healthcare programs, and federal contracting face immediate disruption. Workflows are delayed, projects are canceled, and internal bureaucracy struggles to redistribute responsibilities among remaining staff. The efficiency of government services collapses in the short term. Stock markets react violently to the uncertainty. Investors anticipate cascading economic consequences, ranging from reduced consumer spending by newly unemployed federal workers to disruptions in industries dependent on government contracts. Indices such as the S&P 500, Dow Jones, and NASDAQ experience sharp declines, particularly in sectors heavily reliant on federal projects: defense, aerospace, healthcare, and infrastructure. Volatility spikes as financial institutions reassess risk. The federal contracting industry is the first private sector casualty. Firms reliant on government contracts in defense, construction, IT services, and consulting suddenly face cancellations, delays, and renegotiations. Thousands of private sector jobs linked to federal employment are at risk, amplifying unemployment. Stock valuations for defense contractors, government IT providers, and infrastructure firms plummet as investor confidence erodes. Consumer spending suffers dramatically. Federal employees represent a significant portion of the workforce with stable incomes. With 40% terminated, consumer confidence drops and spending contracts. Retail, entertainment, travel, and real estate sectors face reduced demand. Local economies dependent on federal employees experience immediate strain, particularly in regions with high concentrations of government workers, such as Washington, D.C., Northern Virginia, and parts of Maryland. Unemployment surges. The sudden displacement of millions of federal employees increases the national unemployment rate significantly, putting pressure on social safety nets. State and local governments already stretched must respond to increased applications for unemployment benefits, healthcare support, and housing assistance. This fiscal pressure creates budgetary strain and delays in public services. Corporate operations reliant on federal employees face cascading disruptions. Financial institutions, consulting firms, and IT service providers experience revenue reductions as contracts are paused or terminated. Project timelines are extended, operational costs increase, and workforce planning becomes chaotic. Investors reassess valuations, particularly for publicly traded companies heavily tied to federal projects. Defense and national security are severely impacted. Critical positions within the Department of Defense, intelligence agencies, and Homeland Security are vacated, creating vulnerabilities. Defense contractors face uncertainty regarding project continuity and funding. The stock prices of defense companies fluctuate as investors weigh the risks of operational disruptions, contract delays, and strategic uncertainty. The financial sector experiences indirect but significant effects. Banks, investment firms, and insurance companies adjust risk models to account for rising unemployment, reduced consumer spending, and potential loan defaults among displaced federal employees. Mortgage delinquency rates increase in affected regions, putting pressure on housing markets. Financial markets experience heightened volatility as institutional investors rebalance portfolios to mitigate exposure. Healthcare and social services are under immediate pressure. Programs like Medicaid, Medicare, Social Security, and veterans benefits experience delays in processing, approval, and service delivery. Hospitals, clinics, and state-administered programs face operational challenges due to delayed reimbursements, paused projects, and increased patient demand without sufficient administrative support. Stock valuations of healthcare service providers adjust accordingly. Federal employee terminations affect technological innovation and research. Government-funded research programs in energy, space, defense, healthcare, and AI experience project delays or cancellation. NASA, Department of Energy laboratories, and NIH projects face staff shortages, slowing progress and reducing output. Companies and investors dependent on government-backed innovation experience uncertainty, affecting stock performance and long-term projections. Corporate debt pressures rise. Firms experiencing revenue reduction from federal project delays or terminations struggle with cash flow and debt servicing. Borrowing costs increase as lenders adjust interest rates to reflect heightened uncertainty. Corporate bond markets experience volatility, particularly among companies with significant federal contract exposure. Small and medium-sized enterprises are disproportionately affected. Contractors, IT service providers, consulting firms, and suppliers reliant on federal spending face sudden revenue shortfalls. Layoffs in the private sector compound unemployment, creating localized economic crises. Many small businesses experience insolvency or bankruptcy, reducing innovation and local economic resilience. Global financial markets react to the disruption. International investors with exposure to U.S. government-backed projects or securities reassess risk, causing volatility in U.S. equities and treasury markets. The U.S. dollar experiences short-term fluctuations, while foreign stock markets adjust to shifts in U.S. economic stability and consumption patterns. Consumer confidence plummets. Fear of economic instability spreads beyond displaced federal employees. Wage stagnation, job insecurity, and uncertainty about government stability lead to reduced spending across retail, hospitality, and service sectors. Companies dependent on discretionary spending reduce investments, delay expansion, and cut back hiring. Stock indices in consumer-driven sectors experience immediate downward pressure. Public infrastructure projects are delayed or canceled. Construction, maintenance, and transportation initiatives funded or coordinated by federal employees halt. Companies contracted to execute these projects face uncertainty, operational inefficiencies, and financial strain. Local economies relying on these projects experience reduced employment, slower growth, and budgetary constraints. The real estate market faces localized distress. Areas with high concentrations of federal employees, such as Washington, D.C., Northern Virginia, Maryland, and parts of Colorado, see rising foreclosures, declining home prices, and reduced rental demand. Housing-related industries, mortgage lenders, and property management firms adjust valuations downward, impacting broader financial markets. Stock market volatility remains persistent. Equity indices fluctuate in response to daily announcements regarding federal employee reductions, corporate contract adjustments, and macroeconomic forecasts. Investors shift to defensive assets like bonds, gold, and utilities, while equity exposure in affected sectors declines. Hedge funds and institutional investors implement risk mitigation strategies, further influencing market dynamics. Corporate restructuring accelerates. Firms dependent on federal projects implement layoffs, reallocate resources, and pursue operational efficiency. Mergers and acquisitions activity slows or shifts focus toward unaffected sectors. Companies unable to adapt face revenue declines, declining market share, or bankruptcy. Stock prices reflect strategic uncertainty and operational challenges. State and local governments face fiscal stress. Reduced federal workforce presence decreases tax revenue and local economic activity. Public services, education, and healthcare funding face pressure. Budgetary reallocations create delays in municipal projects, infrastructure upgrades, and community programs. Local economies experience prolonged economic contraction. Unemployment assistance programs are overwhelmed. Increased claims from displaced federal employees strain state and federal unemployment systems. Delays in benefits exacerbate social tension, reduce consumer spending, and increased reliance on non-governmental support organizations. Stock markets factor in potential fiscal interventions and government debt issuance to cover program costs. Corporate investment slows dramatically. Firms postpone expansion, R&D, and hiring due to economic uncertainty. Venture capital funding becomes cautious, particularly for companies dependent on federal contracts. Startup growth slows, reducing innovation pipelines, employment opportunities, and technological advancement. Global trade and economic perception are affected. International partners and investors observe instability in the U.S. government and economy, adjusting investment, trade, and partnership strategies. Companies and sovereign wealth funds reduce exposure to sectors reliant on U.S. federal programs, causing further economic ripple effects. Defense and aerospace firms experience delayed contracts, operational uncertainty, and workforce adjustments. National security initiatives slow, while stock valuations reflect risk associated with project delays, government uncertainty, and international geopolitical implications. Investors weigh long-term strategic risk versus short-term gains. Healthcare providers face reimbursement and operational delays. Clinics, hospitals, and insurance companies experience disruption as federal program administration slows. Research grants, public health initiatives, and clinical trials are paused or scaled back. Stock prices in healthcare and pharmaceutical sectors reflect uncertainty and delayed revenue recognition. Federal employee layoffs influence the consumer credit market. Reduced disposable income leads to increased loan defaults, delayed payments, and pressure on credit card issuers. Mortgage lenders reassess risk exposure, adjusting interest rates and credit terms. Financial market stress emerges as consumer debt performance deteriorates. Global markets adjust currency valuations, capital flows, and investment priorities. Reduced U.S. consumption, government instability, and potential for slowed innovation influence international equity and bond markets. Emerging markets dependent on U.S. trade recalibrate supply chains and investment priorities. Corporate strategic planning shifts to crisis management. Risk assessment, diversification, automation, and workforce optimization become immediate priorities. Firms reevaluate dependency on federal contracts and related revenue streams. Operational efficiency becomes critical to surviving in a contracting economy, while market valuations fluctuate based on perceived resilience. Small businesses in federal-dependent regions face cascading closures. Reduced demand, supply chain interruptions, and employment contraction create a cycle of economic decline. Local banks, service providers, and commercial property markets experience financial stress, compounding economic disruption. Innovation pipelines and public-private partnerships face delays. Research and development funded by federal programs in AI, defense, biotechnology, and clean energy slows dramatically. Private firms reliant on government grants adjust projections, reduce hiring, and delay product launches. Stock markets adjust valuations for firms heavily dependent on innovation contracts. Public sentiment becomes volatile. Citizens fear instability, unemployment, and social unrest. Consumer confidence declines, affecting spending in discretionary sectors. Policymakers face pressure to respond with fiscal stimulus, unemployment programs, and regulatory adjustments, creating additional debt and long-term economic obligations. Corporate debt levels escalate. Firms with disrupted revenue streams face difficulties in servicing loans, bonds, and lines of credit. Credit rating agencies reassess risk exposure, increasing borrowing costs. Bond markets fluctuate as investor confidence is tested, impacting interest rates and financial stability. Global supply chains experience delayed procurement and increased cost. Firms reliant on federal projects adjust sourcing, logistics, and delivery timelines. Operational inefficiency increases, creating ripple effects across manufacturing, services, and technology sectors. Stock markets reflect uncertainty in operational continuity and revenue projections. Defense contractors face additional scrutiny. Delays in personnel, project execution, and procurement schedules influence long-term revenue forecasts. Investors weigh the risks of operational disruption, government instability, and potential policy changes. Market indices for defense and aerospace experience volatility and sectoral realignment. Federal program terminations impact social services. Unemployment, healthcare, and education programs face reduced capacity. Citizens experience delayed benefits, reduced services, and increased reliance on alternative support systems. Stock markets factor in potential fiscal interventions and increased government debt issuance. Corporate investment strategy shifts toward domestic resilience. Firms implement workforce reallocation, automation, and diversification of revenue streams. Operational costs increase and profit margins are squeezed. Companies unable to adapt face long-term market share decline or insolvency. Stock valuations reflect risk and operational uncertainty. Ultimately, firing 40% of federal employees triggers a cascading economic crisis. Stock markets experience prolonged volatility, corporate revenue and profitability decline, unemployment surges, consumer spending contracts, and local economies are destabilized. Recovery depends on effective policy response, corporate adaptation, and fiscal management to restore confidence and operational stability. The scenario underscores the critical role of federal employees in sustaining economic stability, corporate operations, and social services. It demonstrates how mass termination of government personnel can ripple across sectors, markets, and society, highlighting the interconnectedness of governance, finance, and public welfare. In the aftermath, the U.S. economy faces a strategic crossroads. Invest in rebuilding federal capacity, implement robust safety nets, stimulate consumer confidence, and stabilize financial markets, or endure prolonged economic disruption, corporate failures, and geopolitical vulnerability. The consequences extend far beyond the government workforce, affecting Wall Street, Main Street, and global economic influence for decades to come.